Welcome to Julius Baer's Moving Markets podcast on Thursday, the 28th of May with me, Bernadette, and Anderko. I'm looking forward to catching up on the latest financial markets news with Roman Canziani, Head of Product and Investment Content here at Julius Baer this morning. And then we're going to be joined by our Head of Next Generation Research, Carsten Menke, to investigate what's behind the recent copper rally. Now, though, let's catch up with what's been going on in markets in the last 24 hours. Good morning to you, Roman.
Good morning, Bernadette.
So let's start with a quick look back at European markets yesterday. We saw a fairly muted performance despite some positive signals elsewhere. Can you talk us through the key themes influencing investor behaviour?
Certainly. Well, European markets essentially treated water yesterday with the Stoxx 600 barely budging. Gains in auto and chemical stocks were offset by lingering anxiety surrounding the situation in the Middle East and its potential impact on energy prices. Brent crude did fall during the day, around 3%, offering a bit of relief, but the underlying uncertainty persists. Reports regarding potential agreements and alleged ceasefires are constantly shifting, keeping everyone on edge. The ECB also weighed in, cautioning that the conflict, coupled with existing trade tensions, could hinder Eurozone growth, push up borrowing costs and strain public finances. They rightly point out that Europe is particularly exposed due to its reliance on energy imports.
And that vulnerability is definitely a concern. But speaking of broader economic health, Germany, often seen as the engine of Europe, received some sobering news, didn't it? So what's the outlook looking like there?
Well, it's not pretty, unfortunately. Germany's Council of Economic Experts significantly lowered their growth projections. They now anticipate only 0.5% growth in 2026, down from 0.9% previously. Higher energy prices stemming from the Middle East instability are a major factor, along with uncertainties related to US trade policies and deeper structural issues within the German economy. Rising energy costs are squeezing household budgets and curbing consumer spending. Inflation is predicted to creep up to 3% in 2026. Even a moderate increase in oil prices, say to $120 a barrel, could slash growth even further and push inflation above 3.5%. The Council emphasized the need for structural reforms to boost Germany's competitiveness, especially against countries like China.
So a challenging landscape for Europe's largest economy. But now why don't we head across the Atlantic? US markets painted a very different picture yesterday, hitting record highs. So what's driving that optimism?
The story in the US is largely centered around artificial intelligence. Strategists at Goldman Sachs, joining others like Morgan Stanley and Deutsche Bank, are predicting the S&P 500 could reach 8,000 points by year-end, a roughly 6% gain from current levels. Importantly, it isn't just blind enthusiasm, it's fueled by strong earnings growth, with companies benefiting from AI infrastructure investment expected to contribute substantially, around half, to the S&P 500's EPS growth. Though the projection suggests valuation compression, the sheer force of AI seems to be carrying the market upwards. We also saw some interesting individual moves yesterday, with software company Snowflake jumping around 30% in late trading after a surprisingly strong outlook.
Interesting. It seems that everything AI keeps on being the defining feature of this market cycle. Anyway, let's turn to currencies. The Japanese yen has been under considerable pressure. What's going on there?
Yes, the yen continues to weaken, nearing levels around 160 to the dollars that previously prompted intervention from Japanese authorities. Investors seem determined to test the Bank of Japan's resolve. Simultaneously, Governor Ueda has taken a more hawkish stance, acknowledging the sustained energy price shocks combined with wage increases and inflation might necessitate market action. So markets are currently pricing in a substantial chance, around 70% of a rate hike at the BOJ's June meeting. Meanwhile, the US dollar benefited from its safe haven status amidst the heightened geopolitical tensions.
And those tensions certainly flared up overnight, didn't they? News coming out of Asia paints a concerning picture.
Absolutely. Asian markets are reacting negatively to fresh US strikes in Iran and retaliatory actions. Oil prices are surging. Brent is currently trading around $97, up around 3% overnight. Safe haven assets like the dollar are gaining traction, while gold has actually dipped as investors reassess risk. It's trading now just shy of $4,400 on a very important technical support line, I'm told. US Treasury yields, meanwhile, are trading a tick lower too. Major Asian indices experienced a significant decline this morning, reflecting the increased anxiety, but have since recovered a bit. Still, they are generally down a little bit less than 1% as we speak.
All right, then finally, looking ahead to today, what key event should investors be focusing on?
Well, all eyes will be on the US core PCE data released later today. This is the Federal Reserve's preferred measure of inflation, and it will provide crucial insights into whether inflationary pressures are cooling as expected. This comes after comments from Fed Governor Cook expressing vigilance about entrenched inflation and preparedness to raise rates if needed. Otherwise, there's not too much on the plate. Maybe lastly, US equity market futures have ticked up over the last hour or so, but still point to a negative open when trading resumes later today. That's it from me.
Thanks very much for a very thorough update this morning, Roman.
Thank you very much, Bernadette. It's always a pleasure.
And now over to you, Carsten. Good morning.
Hello, good morning.
So, Carsten, copper prices reached a new record high of more than $14,000 per tonne recently. What's behind that rally?
To be honest, I have come across many potential explanations, but none of them was fully convincing in my view. So first, we have the conflict in the Middle East, which is a major exporter of sulfur. Sulfur is an important ingredient to some specific copper mines, and supplies have been disrupted due to the shipping issues around Hormuz, as we know. That said, I'm not aware of any related mining disruptions. Second, there is an energy crisis in Peru, which is an important copper producer, but this is unrelated, by the way, to the conflict in the Middle East. So in March, there was a pipeline rupture, which was fixed quite quickly, and this did not impact mining. Now we're talking about funding issues at the country's state-owned oil company, which does not pose a big risk to mining, in my view, of course, unless the company fails and the mines run out of diesel, for example. And this is exactly why the government has stepped in to avoid fuel supply disruptions. And third, there is, of course, the AI boom.
Yeah, indeed. And isn't that what's driving the euphoria around copper?
Yes, I think so. That said, and I think I'm repeating myself here, data centers use less copper than often perceived. So globally, they only account for 1% of total demand. Plus, power transmission is becoming less copper intensive via incremental innovation of power management systems or also substitution with aluminium. And data transmission is moving from traditional copper cabling to high-performance optical transmission. So rather than seeing data centers as a standalone driver of demand, we prefer to look at the electrification trend more broadly. So incorporating the rise of renewables, electric vehicles, the required upgrading of the power grid, etc. And for us, this is the strongest structural force in the copper market.
And yet I get the sense that that doesn't convince you.
Well, we are convinced about this trend, absolutely. But if we look at the copper market today, or if we look at the copper market this year, it was in a sizable surplus. And this has pushed global observable inventories to the highest levels in more than 20 years.
Is that maybe due to strategic stockpiling? I mean, that's something we hear from time to time.
I think it's unlikely because much of this inventory buildup has been happening in exchange warehouses, which are considered a market of last resort that clears excess supply or demand. This is why we see increasing inventory primarily as a sign of cyclical softness, in particular in China, where manufacturing activity is struggling. Some of the increase in inventory is still tied to potential US import tariffs. So if we look at US warehouses where traders have been shipping metal to the US, storing it there with the intention to sell it at a potentially higher price at a later point in time.
Okay, then. So how do you square record high prices with a surplus market?
I'd say that prices are primarily about the long-term outlook, which still points to structural deficits during the next few years. And the surplus is about the short-term backdrop, which is cyclically soft, but seemingly disregarded by those that are playing the structural growth story. We generally agree with them in terms of the long-term outlook, but still from a more short-term perspective, we believe that prices are trading above what is justified, and that's why we stick to our cautious view.
Clear message there, Carsten. Thank you, as always, for joining us.
Thanks for having me. Bye-bye.
Well, that's it for today's podcast. Thank you for listening. And of course, to Roman and Carsten for being with me today. I hope you enjoyed the conversation. Please do tune in again tomorrow when Helen Freer will be back, hosting more of our experts to bring you up to speed on what's moving markets. So don't miss that. Meanwhile, good luck today and goodbye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.